Welcome back to Strategic Alternatives, the RBC Capital Markets podcast. I'm Bryan Johanson, head of North American client ETF markets, and I'm joined by global ETF strategist Valerie Grimba. Welcome, Val.
Thank you so much for having me, Brian.
Now, the global ETF market has surpassed 20 trillion, but what's more significant is how fundamentally the vehicle has changed. A decade ago, ETFs delivered passive beta. Today, they're used for active strategies, structured outcomes, and solutions that were once institutional only. That evolution creates opportunity but introduces complexity around liquidity, execution, and risk. Today, we're going to explore what's driving this transformation and what comes next. So, Val, to kick things off, what catalyst drove the acceleration in ETF innovation over the past 5 years?
We're in the midst of an absolute explosion in the ETF space. And I think we can boil that down to really two facets. One is the breadth of adoption. So we've seen a wide variety of client types and investors really gravitate to the ETF vehicle for all the reasons that we've known and loved for decades now, but it's really caught on. And of course, those are the features like transparency, intraday liquidity, low costs, and then it's a perfect segue because ETFs have acted as this access tool. The second part here that's really driving this growth is the explosion of products, right? It's this real proliferation of new ETFs coming to the market. 20 years ago, ETFs were this blunt force object. You kind of just had a single index that you could track, and that was a limited use case. Now, with over 4,000 ETFs, I think the number is well over 10,000 globally. Investors can get almost surgical level of precision in creating these portfolio building blocks. And you can get very targeted exposures. They can get in and out very quickly, get that liquidity, and move on. So it's been really quite amazing, but I think we're still early innings here, and we're going to see a lot more growth and innovation to come into the space as we move forward.
Innovation hasn't been globally uniform. We're seeing different strategies take off in different regions. How much of that comes down to understanding the end investor versus broader market structure?
That's a really interesting question, Brian. And I think you almost answer your own question in that it's a combination of both end investor biases and alongside kind of this regulatory environment that is different between geographies. And here at RBC, we do have a very interesting perspective as we really sit at this intersection of the ETF market globally. So we have leading ETF market making desks in Canada, in the US, and in Europe as well. And so we get to talk to both our regional clients and then also the global clients that have cross listed products or even individually listed products across all of these regions. And of course, we look to the US, it really stands apart because of its scale. We will probably see the first $1 trillion ETF this year. And then with that size and scale, we see this kind of big pool of liquidity that is self-fulfilling prophecy in and of itself. Liquidity begets the liquidity. And so the US is an incredibly competitive market and a very wide variety of access points in the ETF structure. Closer to home for me in Canada, it's historically led in areas around income focused products. Canada was a key leader in the covered call space. Canadians are obsessed with yield, and there really is an insatiable demand for these yield focused products. So I think it's still going to be a key growth driver for that region. And then, of course, we have Europe as well, a more fragmented market, but we've seen some really interesting regulatory innovation. Of course, first and foremost, that's the UCITS vehicle that kind of unites these fragmented countries, but also a leader in other aspects of product design, including currency hedges and the like, that are a priority for that region with different needs.
I agree. Europe may be the wild card with its structured product heritage and fragmented landscape. It could play a key role in shaping how complex strategies evolve within ETFs. More developed view on Europe is critical to understanding the next phase of the global ETF innovation. At the end of the day, despite regional differences, the global investor base is increasingly aligned in how it thinks about outcomes, income, downside protection, and defined returns. This is creating a degree of convergence in product design, even as implementation varies by market.
Absolutely. And I think to your point too, Brian, is that there are more similarities than differences at the end of the day. And it's really about bringing those best in class practices across the globe. And I think we're going to see innovation become even more global in nature, particularly as we see other regions really develop, like Asia Pac and the Middle East. And I think there's a lot of knowledge and experience that can be shared between these geographies.
It all really sounds pretty circular, doesn't it? Innovation tends to follow a pattern. New ideas merge in one market that scale through imitation, both regionally and cross border. We're definitely seeing faster global replication of successful strategies as issuers adapt structures like auto callables or outcome driven products into local ETF formats.
Yeah, absolutely, Brian. I completely agree. And look, as we kind of look ahead here, we're obviously witnessing real time this very clear push towards increasing complexity within the ETF structure as investors demand more sophisticated strategies. And I think the key question here is whether markets continue to converge or if they continue to evolve kind of on these distinct regional paths. But I do think that we're going to see again, everyone kind of working together to deliver best in class practices.
Now, Val, would you agree the market is crowded?
It is increasingly competitive, let's say, but I think there are still lots of avenues that have a long runway ahead of them.
So, when asset managers evaluate launching an ETF, what are the toughest questions and where do launches go sideways?
Both of us are having these conversations every day with our most trusted partners, and it really is about walking through the entire life cycle of the ETF. Asset managers really need to think through what problem is this solving for my clients? What end need am I meeting? Then, furthermore, they need to think about how they're going to communicate that. How are they going to deliver this high level of engagement with their client base to make them want to own this product to deliver the outcome that it is designed to meet? I think it's no longer about can we launch an ETF? The conversations we're having are should we launch this ETF? Product construction within an ETF is very important, and asset managers often talk about the nuts and bolts of the investment strategy itself. But then there's the end of day where the ETF is live trading on the market, and very much so, this portfolio construction translates into how market makers can price two sided markets on that strategy. And sometimes we will see these products that are very similar in strategy, but on screen trading is actually quite different. And there's almost always a reason for why spreads are the way they are. You know, in ETF world, we like to talk a lot about the arbitrage mechanism. And so effectively, if spreads are wider than someone would like them to be, there is a reason behind that. And oftentimes it can be traced back to portfolio construction. So these important conversations we're having as they go through the product development pipeline is coming up with indicative spreads, understanding what it would look like when we're using our trading technology to price that ETF, going through the iterations of what would it look like to trade $10 million, $100 million of this ETF, and understanding the machinations of actually executing and trading with your ETF because you want it to be as seamless as possible.
I guess they say the devil's in the details, and no matter how much alpha is embedded in the underlying strategy, it really boils down to not only the performance of the fund, but also the performance of the market structure.
Absolutely. It's a great point.
Now, the pace of innovation is introducing additional complexity for market makers. What are some of the key considerations that are thought about in terms of developing a spread and quote quality?
Quote quality is so important. And again, I think often overlooked. And the reality is, we like to go out there and say, hey, listen, our trading technology is so strong and so robust that we could, for a simple equity strategy, theoretically add, almost limitless amount of tickers to our trading tech stack. But there is a very real reality that there are some constraints in the system, and that's really borne by the amount of resources that it takes for a market maker to provide those two-sided quotes, to engage in the secondary market, and again, to uphold quote quality. And so when it comes down to this increasing complexity that is coming into the ETF structure, this often requires a bigger development lift on our side, on the market making desk. It also usually requires ongoing maintenance, and this just requires extra time, extra costs, and extra initiatives by the market makers to uphold this liquidity and this intraday trading profile. And so I don't think we're looking at any kind of like catastrophic bottleneck here, but the reality is that the intraday liquidity, tradability of ETFs are such key features. And as we're seeing increased complexity come into the structure, we need to remind kind of all participants in the ETF ecosystem what really has to go on behind the screens to create a seamless, frictionless trading environment that we want all investors to have when they interact with an ETF.
Love that. Behind the screens instead of behind the scenes. So we're seeing remarkable growth in structured products and systematic strategies. In your opinion, what's driving that, Val?
We're seeing increasingly volatile environments. We've heard a lot about the death of the 60/40 portfolio. We had 2022 where both stocks and bonds, the inverse correlation broke down and both were negative. And so investors are looking for other opportunities, other ballasts within their portfolio, and really other ways to look at delivering either alpha or capital preservation or other strategies to meet their end goals. And then we have this gift of accessibility through the ETF. And so we like to throw around this word democratization of investment strategies. So, because of the ETF wrapper, we can deliver these strategies that previously were only the domain of institutions. So, I think that's really what has been driving this increased growth that we're seeing in both structured outcome ETFs and more systematic strategies as well.
And now, as these products are growing and becoming a little bit more complex and introducing new asset classes, from not only a fundamental performance point of view, but from the secondary market, what do investors really need to understand about that?
Yeah, I think it's first and foremost is understand the product, do your due diligence because most ETFs at the end of the day, they are doing what they're designed to do. So you need to understand the trade-offs that are embedded within ETF. And then secondarily, to your point, is how does this trade and can I interact with this ETF? And how do I is either minimize execution costs or make this as efficient as possible for me to enter or exit out of positions. And ETFs trade continuously providing this intraday liquidity and price discovery, even when underlying markets might be less active. So these are very real considerations and, you and I both know that execution is a very critical part of the investment outcome. So, in more complex or potentially less liquid strategies, thoughtful execution and potentially even working with an experienced trading partner can really be a helping hand here in driving the best outcome for an end investor.
In a lot of ways, it's one of the key benefits of the structure, right? Is that it can be the mechanism of price discovery, for example, a market that's closed during local hours, or to your point, a less liquid asset that maybe isn't trading during a time of market volatility.
Absolutely.
So, looking forward, what comes next? 3 to 5 years from now, what has the most potential to reshape the ETF landscape?
I think it's going to be really kind of a continuation of some of the themes that we're currently seeing play out in the market, but also a shift kind of towards a more global system. So I definitely think that structured outcome strategies will continue to grow here, especially as education increases, as investors gain comfort, and really as, again, the number of products in different iterations of these defined outcomes expands. I think this is definitely going to be another avenue that we see growing in the ETF space. Of course, I'd be remiss not to mention ETF share class, which is a bit of a dead horse that's been beaten, but it never really was in my mind going to be an overnight flip of the switch. But the reality is it is going to have this broadening effect that we are going to see more asset managers bring products that historically lived in their traditional mutual fund world and port that into the ecosystem of ETFs.
Now, with share class, obviously, we're starting to already see some fund managers bring the structure out. I do believe it will result in a significant proliferation of product in the market. which could not only allow investors more variety of choice, but also reinforce some of the constraints that are facing market participants.
Yeah, that's a great point, Brian, about kind of, again, as we see this product proliferation come to fruition. And then, of course, we've got issuers trying to take a stab at bringing private assets into an ETF vehicle. Now, this one is a little bit potentially more of a hot take because there are some trade offs here, again, with the things that we love about ETFs, might not being super congruent with all the things we love about private markets. But I do think we're going to see continued innovation in the space here. And then the last point that I would think about as we look into the future is, of course, tokenization. We're talking to asset managers that are readying teams of people to think about what tokenization looks like. And then, of course, how that interacts with the world of ETFs as well. And I think we see a lot of potential here to streamline some of the infrastructure that we'll deal with behind the scenes. It could also enable more flexible product design and, of course, expand global reach as well. And there are going to be operational complexities, but ultimately, I think we're going to see just continued growth in the ETF vehicle, how it's accessed, increasing liquidity, and then, of course, overall investor demand as they continue to pivot or seek out the ETF vehicle as their structure of choice to access specific investment outcomes.
Thanks, Val. That's really great perspective. The ETF market is entering a more complex and interesting phase for sure, and I am very excited to be part of it.
Yeah, thank you so much, Brian. I am as well, and I look forward to continue to see what innovations are around the next corner.
To our audience, you've been listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on April 17th, 2026. Listen and subscribe on Apple Podcasts, Spotify, or wherever you get your podcast. If you found this valuable, please let us know, and as always, subscribe and share it with your colleagues and friends.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.